Hello, good afternoon and welcome, and thank you very much for that. So we've got a 30-minute webinar today, nice and short and sweet, packed full of lots of information with the option of questions at the end, as just mentioned. So I'm Phil Lloyd, I'm business lead for NatWest Markets, LIBOR Transition, and I also co-chair the Sterling Communications and Outreach Group, along with sit on some of the European groups. Today I'm going to ask some pretty difficult questions to get things going. Some of my colleagues, we've got quite a range of colleagues on the panel with me. So we've got Dave Housted, who sits on our Sterling Swaps desk and has been quite actively engaged with the LIBOR transition over the last few years. In addition to him, we've got Jamie Thrower, who is our business lead for the corporate bank of NatWest LIBOR Transition. He also chairs the Loan Enablement Task Force for the Sterling Risk Rate Working Groups. And then last but not least, Luke Hasham-Smith, who sits in our financing and risk solutions team. And again, likewise, has been very engaged working with corporates on the loan and also the risk solutions element. So lots of insights and information in these guys' heads we're going to tap into today. So in the last 6 months, we have seen a huge uptake in new products, new SONIA products, and lots of developments there. We've seen liquidity build in the linear market, slowly in the non-linear. The bond market's very progressed, and we've seen a lot of uptick eventually in the loan market, and lots to talk about there. We've also seen the RFR machine pump out a lot of white papers and discussion papers, and it's a lot to get through. And so what we want to do today is unpick some of that and really highlight the things that we think you need to be focusing on. The focus, as I said, is really now on turning off the taps of LIBOR. We've got some milestones we'll talk about today, which are really getting to the heart of turning off the taps. And then in addition to that, we've seen some quite clear announcements on March the 5th that LIBOR's ending. And we've seen just last week a pretty strongly worded DSCO letter to sort of banks and institutions around the official sectors using their supervisory powers to ensure these milestones and additional transition mechanics are met. So I guess the tone is turning up, the heat is turning up, and lots to focus on, noting the little time. And then, but the sort of last point for me before I bring Dave in is really the focus on engaging us at NatWest and the broader market on active transition. I think it's the clock is ticking, and we've got to get sort of the legacy exposure down, and we can work with you and help with you on that. So Dave, let's bring you in. March the 5th, I sort of talked about that big milestone. I guess the question is, was it significant? Is it significant? Were there any surprises, or was it just the worst kept secret?
Yeah, sure. Hello, everyone. I mean, it was significant. It's been a lot of talk over several years, and all building up to this point, really. We already knew the method that ISDA were going to use for the fallback, and on the 5th of March, we finally got the details and can calculate the numbers behind this method. The other really significant thing was we got certainty on the date. So we now know that the last LIBOR we'll get under the current regime, if you like, this kind of current waterfall methodology that ICE use, will be on the 31st of Dec this year. And then LIBOR stops being LIBOR as we kind of currently know it. And from the 4th of Jan, if you've signed up to the protocol, any of these remaining LIBOR fixings that occur will become the realised SONIA rates over the same period, plus the spreads that we calculated on this 5th of March snap. So, yeah, very significant. You also asked if there are any surprises. And to be fair, this was pretty well signalled or signposted from the end of last year. And we had the ICE consultation, and this is ICE as the LIBOR administrator. We had their consultation that closed at the end of Jan. And there was kind of this general expectation that an announcement would come shortly after it. And so if anything, and from the number of questions that we started getting on the desk in the days before we actually got the announcement, I think the bigger surprise was really just how long it had taken to get the announcement out there. And to be fair, the market was very neatly pricing current estimates as we were approaching this date of where the LIBOR would be. So I think there was really just a general sense of relief that after all the consultations and working groups, we'd finally drawn a line in the sand, could calculate and lock these spread numbers once and for all.
Thanks, Dave. And then let's maybe turn to this Q1 milestone. So I talked about 2 milestones earlier, but from a derivatives perspective, is this a game changer? Is this going to really change things? And anything that you want to sort of draw out from your perspective on this milestone?
Yeah, sure. Let me just start by just kind of reading out the summary of what the milestone was, which was by the end of Q1 2021 to cease initiation of new GBP LIBOR-linked linear derivatives that expire after the end of 2021. Which obviously sounds like a game changer, but actually there's a key exemption which I'll move on to shortly. Will it be a game changer? I mean, for some, yes, but many people in the market had already switched to SONIA and certainly had done so for the new business they were doing. And as we kind of said already, we know the spread that we've got between the LIBOR fixings and the SONIA for the same period. So if you're trading a LIBOR swap, you're really trading a SONIA one anyway. The market's just as liquid. So it makes sense to me to trade the SONIA in the first place and not have to deal with the fallback or transitioning later. Now, I said that exemption that's in there is key, and people still have LIBOR exposure, and we're here to help you transfer it into SONIA. And to do that, a lot of people will want to be able to trade a LIBOR swap in order to offset their position or tear up an existing trade. And the exemption enables us to do just that. So if you have a LIBOR trade to do and it reduces your LIBOR exposure, then we're still here to help with that. We've also had a lot of questions around how closely we think this will be enforced. And I kind of sympathise with that. But I guess because of all the chatter that surrounded it, the FCA on this past Friday published their latest Dear CEO letter. And to me, it made it very clear just how seriously they're taking it. And they really do want to see all new business in SONIA space. And you kind of, the letter in itself was interesting, but actually below the letter, there was an annex there. And it was very clear in the terms in the annex of the letter that not being ready is just not going to be a valid excuse as far as they're concerned. But kind of as I said, I think the time's right. The fallback spreads are locked already. So in a sense, you're effectively trading SONIA, even if you're trading a LIBOR swap. The time's right. It makes sense just to be doing SONIA now in the first place and then not having to worry about transitioning more or later when the time comes.
Thanks, Dave. So I guess we can expect a lot of questions from the various desks to the clients who do want to come in and trade LIBOR and understand the reason and the purpose why. Fair enough. And then what about the bilateral and the cleared market? So LCH have recently come out with sort of their plans. Are the paths now aligned between the bilateral and the cleared market?
So yeah, the aligned yes and no, I guess, is the honest answer. Big picture, if you signed up to the protocol, then you're aligned other than some minor differences. For example, administratively, the clearinghouse LCH are going to process their rebookings a few weeks before the actual end date of LIBOR. So over the weekend of the 18th and 19th of DEC, they'll process the rebooking. Everything will go to SONIA in the clearinghouse. They've also managed to avoid having to have the 2-day lag in SONIA observations that ISDA have used. The other good news in terms of alignment is that we've had an announcement out of ICE, but the futures side this time, who announced they'll be falling back short sterling 3-month LIBOR futures on that same weekend. So they'll be neatly switching open positions in LIBOR contracts into equivalent ones in the SONIA contracts, and all using this same fallback spread that we talked about earlier. So again, this is something we probably all assumed would happen, but it's good to actually have it confirmed. And I guess in that sense, though, it's kind of not all good news in the confirmation front, in that we're still missing a rather large part of the puzzle, and that's the solution for tough legacy. So if you have a LIBOR exposure that's not covered by the protocols or fallback, we're still waiting to hear. We know that the FCA have the powers to effectively redefine that LIBOR 01 fixing page, and it makes sense for them to do this. And also it makes sense for it to become a function of term SONIA plus this same fallback spread, such that it's all consistent. But at the moment, we're still waiting to hear confirmation that that's what they'll do. Frankly, I'd be shocked if it doesn't neatly line up. But as we all know, accidents can and do happen.
Thanks, Dave. Okay, let's move on to Jamie, and let's focus now on the sort of the loan market. So Jamie, I guess, Dave talked about the Q1 milestone for linear derivatives. We've now got a Q1 milestone for sterling loans. So I guess my question is, what do you think it's going to look like? Are you going to have any liquidity issues? And sort of any impacts on the sort of sterling optional currencies that you could shed light on for us?
Yeah, thanks. So the Q1 milestone for loans, I think, is an important milestone, but oughtn't really be particularly disruptive in the journey from LIBOR to SONIA. So just to sort of briefly recap what the milestone means, it means that from the end of Q1, we are not to provide any new GBP LIBOR facilities that mature beyond the end of December. The reason I say that it's a significant milestone, but I don't feel it ought to have a huge amount of disruption, is because it's been very well trailed, and it was sort of preceded by the Q3 milestone in 2020, which required all lenders to make available alternative sort of non-LIBOR products. So I think we've had a clear kind of 6-month run and more. A number of us have been writing SONIA facilities for sort of 12, 18 months now. So there's been a clear run of available product set with which to meet client need. So the turning off of the LIBOR element of that, if you like, should be relatively straightforward, certainly from a liquidity perspective. I think where the ripple might come is that for the last 6 months, the industry has had available and has quite liked a kind of LIBOR switch mechanic construct or an agree to agree. So it's essentially addressing within a LIBOR facility the requirement to transition to SONIA, which provides both the sort of comfort and liquidity that LIBOR facilities were offering, while also some of that certainty around transition. So those will no longer be available. And I guess from a NatWest perspective, we've observed kind of popularity, if you like, of those products to be relatively equal, actually, over the last 2 to 3 months or so. So customers not being able to access a switch product, I think, will be won't be news to them, but will be a little bit different. But as I say, my perspective is that on the sell side, the product set has been available for quite some time. So we feel, A, that we've got the knowledge, but B, that we can then help any of those customers for whom taking the leap fully is still new territory, if you will. I think in terms of one of the other things that milestone does is it just sort of, cements the slight disconnect in timing across currencies and approaches that different regulators are taking. So clearly, that is giving rise to questions where sterling is an optional currency in a multi-currency facility. Do I see that having an impact rather? I think it depends on how. Is sterling the base currency with sort of dollar and euro as an option, or is sterling sort of an optional currency that historically hasn't been drawn? In that respect, we have seen sterling being dropped as a currency from the options list, because clients are more focused on, as I say, the euro or dollar aspects. But that's not an enormous surprise, and is I guess a relatively natural consequence of a slight distortion in the kind of alignment in timing that different currencies are taking.
And actually, speaking of timing, I guess similar question that I asked Dave earlier, which was, I guess, March the 5th announcement. To what extent does that impact the loan market? And in December, we saw the credit adjustment spread paper delivered on people's doorsteps. So how does that connect the announcement, the credit adjustment spread paper, and sort of the active transition? How does that come together?
So I think the March 5th announcement, on a very sort of tongue-in-cheek level, demonstrated that this is actually happening. That clearly those of us on this screen have believed that for some time, but that's not been a universally held view across the customer base. So I think the most important thing that March the 5th delivered was the certainty that this is happening, and that from 31st of December, LIBOR will no longer sort of be a representative rate. So I think that it has had, again, similar to what Dave's been observing, it's generated a sort of an immediate influx of queries and questions from clients around, and to my earlier point, okay, so this is happening, then hot off the heels of Q1, LIBOR is not going to be kind of an option for me. So what do I really need to know, and how do I engage with this? So I think it's generated that client interest and arguably a greater degree of traction. In terms of the mechanics, what it did was very, very important in establishing what the credit adjustment spread would be on the 5-year historic median basis. Now, in the loan market, for your existing stock of LIBOR exposures, you can transition to SONIA in a couple of different ways. One of those is on a deferred basis. So you sort of do all of your documentation now, but operationally the loan flips on the first rollover date post cessation. For any transition of that nature, the credit adjustment spread element is calculated using the 5-year historic median. So we now know today what that credit adjustment spread is going to be, which again provides a great deal of confidence and comfort for the market in kind of weighing up some of the economics around associated with transition. So I think that's probably been its greatest impact in terms of detail. I should just sort of conclude that the other way of doing that is still a pre-cessation transition using the swap forward methodologies. And so I think we're seeing people now starting to get into, okay, so now I know the CAS element on a sort of deferred switch basis. What does the scenario look like for me were I to move pre-cessation? And that's not purely an economic argument. There are a lot of factors that go into that decisioning, but all of this conversation has become very live and real in only the last sort of 3 weeks or so. So I think that's probably the real impact that the March the 5th announcement has had in the lending space.
Thanks, Jamie. I've already got quite a few questions coming in on very nuanced cases around using CAS. So I guess probably just say to engage the people you're engaged with in NatWest, and which you sit behind them all. So lots to discuss. It's quite a nuanced topic. You talked about March the 5th and it's happening. I guess on the flip side, it's not happening. It takes me to maybe a question around term rates. I feel that the UK has changed quite a lot its debate about term rates. And only last week we saw the FMSB publish a paper which pretty much mirrored the user group paper. Do you want to talk to me about that?
So I was involved in pulling that paper together for the FMSB, and I think it's comforting in the one hand because it does essentially reinforce the findings or the position put forward by the use case task force sort of 12 and a bit months ago, I suppose. On the other, I feel that the entire discussion around terms, certainly in the lending space, has kind of moved on, to be frank, sort of since 18 months ago, I guess. I think when people first started to engage with understanding what SONIA was and were arguably struggling at that first hurdle of, well, how do I move from a forward-looking rate to a backward-looking rate? People rather hoped that term SONIA might be a widely available solution. But I guess for all the reasons that people were attracted to it, those are precisely the same reasons that the regulators have been very clear on and keen to limit limit its use. So I think where that concluded was in a consistent and sensible place, available for sort of trade and working capital and invoice financing type products that require an element of factoring or discounting to them, and also recognizing a legitimate requirement in sort of some of the more retail areas around mortgages and that sort of thing. So certainly at NatWest, that's the way in which we've designed our go-forward product set. So Term SONIA is only available in our trade and working capital business, and that's an approach that I've seen consistently amongst the peer group, and I'm pleased to see kind of ratified, reinforced, set out in paper by the FMSB.
Yeah, actually, recently we've seen a lot of news from the US, officials at the ARC, saying something similar. Don't wait for a term rate. So I think the market wants that clarity and allowing the conversation to move on. So Luke, can't let you get away with no questions. So let's bring you in. And obviously you sort of straddle both sides of Dave and Jamie in some sort of fashion. So what are the corporates saying around sort of the ISDA protocol? Is this, what are they hearing? What feedback can you give to the broader audience here today?
Yeah, so thanks, Paul. So the ISDA protocol, as Dave says, it changes the definition of the fallbacks from something that currently doesn't work at all to something that does. So you pay $500 to sign up, and then that will apply to all of the institutes that you have with any other counterparties who have also signed up, and all the banks are signing up. The definitions will change to, as Dave says, a daily compounded rate plus a spread, and those spreads are now known. They're on Google, so it's just become a lot more familiar with people for people to see what they are. As James says, it will kick in at cessation, and so it's very neat in that if you have a deferred switch loan, then it lines up so that it kicks in at the same point. So it's viewed as a very simple method to reduce your LIBOR risk. So we expect a lot of corporates to do that. Some have already started to, and some will do, even if they're going to proactively transition, they might just do it as an insurance. There are a couple of considerations. One is that you're not completely done operationally because you've still got to rebook your derivatives or your loan post 31st of December. And also there's a slight mismatch in the resets between the protocol and the loan convention.
Okay, and then is there an alternative? Like noting that it's not ideal, what else do we do?
Yeah. So you don't have to wait. You can go down the proactive route. So you can amend the floating leg of your derivative from LIBOR to the risk-free rate. In that case, you're doing it based on the implied difference between the LIBOR and the risk-free rate for the remaining term of the trade. So it's a bit more work than a protocol, but it's still fairly simple. It's transparent, and also it means that you can be completely bespoke. So you can match the loan that you're trying to hedge exactly the same convention.
Okay, and then you sort of touched on this earlier, and it's a question we get asked a lot. Is we're talking about this mismatch? Is this mismatch a big issue? Is it a theoretical issue, or something that people need to be really alive to?
Yeah. Okay. So the mismatch comes through. These are daily rates. The risk-free rates are daily rates, and so as a standard, you don't know what your payment is until the end of the period. The market's introduced a look-back concept, but it's different across different products. So for the loan market, it's a standard 5-day look-back. Derivatives are bespoke, so you can match it to the loan. But the ISDA protocol, frustratingly, is 2 days. And it's just 2 days. So there's a very slight difference in the resets between a loan and an ISDA that goes a swap that goes through the ISDA protocol. And it is a small difference, but it's something that people do focus on. Some will just run that risk because it's small. Some will either go through the proactive route that I just touched on, or some will transition through protocol and then tweak their trade so that it matches the loan precisely, say in January.
Okay, and then conventions. What are the differences that people need to be aware of from a convention perspective?
So I guess we touched on the one with the mismatch. The other mismatch is in the floors that are in loans. So a risk-free rate floor in a loan is each reset, so every day is floored. That's different to swaps that go, or floors that go through the protocol, where rather than each individual reset being floored, it's the payment. So say you're paying quarterly, it's the quarterly payment that's floored. So it's slightly different. And you can imagine, say you've got a 0% floor in your loan. If you had some resets in that period, positive and some negative, you might get a slightly different result through the protocol than through the loan. Again, it's fairly small, and you can mitigate it by doing the proactive route and getting the bespoke floor, or by tweaking post-cessation. But it's something to be aware of.
Thanks. Actually, I just got a question coming from Mike asking about caps and floors and how does that transition work. What about accounting? Anything there? I feel like I have to ask you about accounting, Luke.
Yeah, so I guess there's two things on accounting. First is, if you're going down the proactive route, the IASB have helpfully confirmed that if you're only converting from LIBOR to the risk-free rate and you're not changing anything else like tenor or anything, then that's not a de-designation event. So you can continue your hedge accounting relationship unchanged. So that's good. The other one is this mismatch. So the 5 days versus 2 days. We can't give accounting advice, but our view is that this is really small difference. And so we wouldn't expect anything to have to de-designate as a result, but you'll get a tiny amount of ineffectiveness through the P&L because of it. And that's something that obviously people need to check with their auditors when they're looking at it.
Okay, thanks, Luke. I'm just conscious of time and I've got questions coming in. So I guess just to build on Dave's point earlier, so it was mentioned today at the main RFR working group, actually, like tough legacy. I think that there are consultations to be had. There's going to be some clarity around what proportional or situational scenarios products will fall into tough legacy, but it's not a fallback is I think the message that we heard earlier, Jamie. And then another point I wanted to make is March the 5th, one of the questions I got most asked was about Euro LIBOR and Euribor. Euro LIBOR, very rarely used, but that is in scope of the March 5th announcement. But Euribor is still staying for the foreseeable future, to quote my sort of European RFR colleagues, although I think that the pressure will be increased on Euribor, noting the path for sterling and obviously the increased pressure on dollar LIBOR. And I would also add that from industry tools and what's out there, the ICE, the benchmark administrator, are now publishing a series of kind of indexes or indices, depending on which way you go. I think they've got 10 of them at the moment to take account different conventions, 2 days, 5 days, shifts, lags. And I think their goal is to really try and sort of standardize the market from a loan market perspective. And naturally, I wouldn't be remiss of me not to plug realiserate.com, which can help and marry that and final coupon payments. But I guess my overarching message is, off the back of the DSCO letter as well, but it's not new to us, is active transition is the path forward. The products are being turned off, and there's loads of experts in NatWest that can engage you, and obviously my colleagues here today. I've got a question here, actually, maybe that I've touched on, Luke. One for you is how can one get better clarity on that final kind of payment certainty, noting we've got backward-looking rates?
Yeah, so that's something that comes up from time to time from customers who obviously been used to having that certainty 3 months before. So you can take out a short-dated interest rate swap where you say you're paying SONIA on your loan, you can receive SONIA exactly the same, the daily fixings paid at the end of the 3 months, and then pay a fixed rate in return. So you're effectively just locking in that 3 month period. You could also make it 6 months if you want and do 2 periods. It's quite flexible. So that's definitely an option for people, and I think some people will do that. It's obviously more of a consideration for those that have never done a derivative before, got to go through onboarding and that kind of thing. But it is definitely an option if you really do want that certainty for, say, budgeting or forecasting.
Okay, thanks, Luke. I have a couple of questions for Dave. One on caps and floors, but I think Luke's touched on that. The other one is around, you talked about the spread being locked in. I guess, what is that spread and to what extent do I care? Good one for you, Dave.
Yeah, sure. So let me, I guess I'll start just by very quickly recapping. what feels now like many moons ago ISDA did their initial consultations, and they came up with a solution to try and work out how we could set some kind of fair transition mechanism between LIBOR and SONIA. And they wanted something that was simple, they wanted something that couldn't be manipulated, and they wanted to minimise value transfer kind of at the point that it fell back. So what they came up with was we would look back over a time period, which was 5 years in the end, and take a median average of these spreads. So what we knew on the 5th of March was from that date, those calculations could be snapped. So effectively, they're looking back for that 5-year time period and working out the median average. And as Luke mentioned, you can Google and get the official numbers. If you calculate them, you'll get for, say, SONIA versus 3s, 11.93. And for SONIA 6s, 27.66. And so this means that past the 4th of Jan, any LIBOR fixing we have will then take the realised SONIA for that LIBOR period, apply those spreads, adjusting for the 2-day look back that again Luke mentioned, and this will be the rate that replaces LIBOR rather than taking LIBOR off the LIBOR page as we currently would. So, yeah.
Okay, thank you for that. And obviously the March the 5th, regardless of the dollar June 23, that was the date everything was locked in. Is that right, Dave? Luke's
yes, exactly. So even though dollars continues until June 23, the spreads that will apply after June 23 will be exactly the same. And so there's a longer window to run into it, but yes, effectively anything beyond June 2023, you can work out what the spread between each fixing is based on these official numbers, which again, I believe if you stick into Google, you get a nice document with all of them listed out, rather than me bingo calling numbers.
Brilliant, thank you. Okay, question a bit long one. Given the recent RFR milestones and reinforcements from the CEO letter, do the panel have a view on whether participants in the listed and clear derivative markets are more likely to transition in the market ahead of cessation, as suggested by the working group, or wait until exchange converts any remaining open interest in sterling LIBOR derivatives to the representative SONIA products just prior to year end? So I guess early or later. Dave, one for you?
Yeah, I have to say that one as well. I mean, I think it's a really great question, and actually I think you can apply it to kind of all products in this space. And in all honesty, I think it's very hard to kind of pre-guess behaviour, because it's going to depend very much portfolio by portfolio on what people have got, what their exposures are, how they run their business. And I suspect in truth, we'll see a mix of all three. I'm sure in a dream world for the official sector, my answer would be proactive transition. It will all happen neatly now. But I think we all know reality is more complicated than that. And it will doubtlessly be a mix of those. And I guess we should say that all these kind of milestones that we're seeing are just an effort to help keep the pace up and to promote active transition. And I guess to Mikey's question about the non-linear space, well, we've got a milestone coming up in May that, in the same way that for vanilla swaps, we're stopping this Thursday unless it's risk reducing, whereas of course we're here to help. That's going to be the same for the options guys as well as of sometime in May. So yeah, I mean, it's all pointing in the right direction, but I don't think there's one hard and fast answer to any of it.
Yeah, agreed. And I guess my and NatWest asks is to all the customers on the call is, let us know your plans, because we want to ensure that we understand what you want to do. Go early, go late. If so, why? And I guess that's part of this. This is not just, this is a two-way conversation, I guess, that we would encourage you to sort of engage all of us on. And then another question here, which I think I'm going to ask, it's around a specific trade and how do you price up for loans and SONIA v LIBOR. But I guess, Jamie, Luke, I kind of asked the person who sent that to come directly to you with that question, if that's okay. And then question for you, maybe Luke, are there standard ISDA confirmations which take into account different RFR conventions like 5-day look back, etc.?
It's a good question. The last time I checked, they frustratingly weren't, and that would have been a bit of a pain, to be honest, in that the customer was looking at doing a trade and they were doing it with a few banks, and each bank had a slightly different way of wording it. So that was frustrating. I think that's a good follow-up. Well, I will check to see if that has changed. I hope it has, but if it hasn't, then it's something to work on. But we'll follow up.
Yeah, and I also think that this sort of takes us back to the question earlier about the 2-day and the 5-day. To what extent is it a real issue or a theoretical issue? And I guess having a look through the portfolios, having a think about that, and engaging your fine self is probably the way to do that. That's it for the questions here. They're pretty good questions, and again, there's just one we'll follow up with. So I guess message for me is pretty simple. I guess with the team is, engage us. If you're not going to actively transition, then come and engage us as to why, so we know. And obviously, the pressure is mounting, and so please just keep the conversation going, and we're here to help across loans, swaps, and non-linear products, and all of it. So thank you to Dave, Luke, and Jamie, and Gareth. I'll close the call there. Thank you very much.